Namaskar and a warm welcome from Samvaad. This is budget season. On the 1st of February 2022, the Union Budget was presented by the Honorable Finance Minister in the Parliament. As the country carefully navigates towards regaining pre-pandemic levels of economic activity, Budget 2022 holds special significance. While there are green shoots of a quick economic turnaround, there are also challenges to be overcome. With a focus on easing tax compliance and providing tax certainty, Budget 2022 brings with it several systemic and legislative changes. From a code to tax digital assets, to phasing out of several exemptions, Budget 2022 ushers in yet another set of reforms. To delve deep into Budget 2022 and its underlying philosophy, we have with us today Srimati Pragya Sahay Saksena, Member, Legislation and Systems in the Central Board of Direct Taxes. As Member Legislation, Ma'am supervises the functioning and the coordination in the important Tax Policy and Legislation Division of CBDT, which is responsible for formulating direct tax policy of the country. She is from the 1987 batch of the Indian Revenue Service, having served earlier in various critical posts. She was posted as the Joint Secretary in the Tax Policy and Legislation Division and in the Foreign Tax and Tax Research Division. Subsequently, she served as the Chief Commissioner of Income Tax, International Taxation in the West Zone. Good afternoon, ma'am, and thank you for coming to Samvaad.
Good afternoon and namaskar to all the viewers.
In the first episode of Budget 2022, we shall be discussing the budget from the point of view of how it has taken several important steps towards improving ease of doing business and further enhancing tax certainty in the country. Two really significant objectives that the Income Tax Department had targeted over the last decade. So, ma'am, reducing litigation is something that is very important from the department's point of view, which it has been striving to do over the last many years. So, Budget 2022 also takes a very important step in this direction. Can you explain a bit about that to our viewers who are watching us from across the country?
Yeah. See, reducing litigation and promoting voluntary compliance has been one of the major focus areas of this budget, and a number of measures have been taken in that context. And so far as reducing litigation is concerned, a number of measures were taken last year also, and progressing further from there, we have taken some measures this year. There is a provision under the Income Tax Act which provides that if there is an appeal filed by the Income Tax Department, that is a concept of repetitive appeal. So to reduce repetitive appeal, there is a concept under the Income Tax Act contained in Section 158AA, which says that if there is an appeal pending before the Supreme Court in the case of the taxpayer or assessee in a particular year, then in subsequent years, if the identical question arises, then the department may not file an appeal if the taxpayer agrees that it is an identical question. But this is limited to a taxpayer's case only. Now, this concept has been broadened, and now the Finance Bill 2022 proposes to introduce another section whereby the scope of reducing repetitive appeals has been taken care of, and what has been provided is that if there is an issue, a question of law pending before the jurisdictional high court or before the Supreme Court in case of any taxpayer, and the same question arises in the case of any other taxpayer or the same taxpayer for any other assessment year, and the taxpayer also agrees that it is the identical question, in that case a collegium will decide that there is no need to go for appeal at that stage against the order of the CIT appeal and against the order of the ITAT, and only an information will be sent to the concerned appellate bodies as per the Act, and after the final order has been received, thereafter, if this order which has been received finally is in contradiction to the order which was decided by the appellate authorities whose order we have not appealed against, then an appeal will be filed within 60 days from the date of receipt of the final order. So this is a concept. This will be reducing the appeals substantively and repeated appeals on the issue, and the issue will attain finality, and thereafter it will be applied in the case of all the taxpayers. This is what is the proposal, and I think this will take care of a lot of litigation both from the side of the department, and since the taxpayer will be on the other side, his time and energy will also be saved to apply it for the productive work which he is supposed to do and earn revenues and give the fair share of taxes to the department.
Absolutely. Thank you so much, ma'am. Ma'am, and the second, another important provision that has been proposed in the budget is the concept of updated return. This is for the first time that it is being proposed. So can you explain how is it different from what we already have in the form of a rectification of return or a revised return or a belated return? What is it that is actually, what does it bring to the table, and how are taxpayers benefited by it?
See, as I said, that this is another measure for improving voluntary compliance. It is in that direction. So today the law says that if I am liable to file my return and I am liable to pay taxes, then I have to file return as per the due date. And the due date has been provided under the Act. If it is a company or if it is a taxpayer who is liable to audit, then the date is 31st October of the assessment year. And if it is a person who has entered into an international transaction, then the date is 30th of November. In any other case, it is 31st of July. And this return can be revised, which you are calling rectification. So that we use in the context of rectification of an order. So the revision which the taxpayer can do, that can be done by the December. That means a taxpayer for whom the return filing date is 31st of July gets 5 months to revise the return. If it is a company or if it is an auditable person, then that person gets 2 months to revise the return. And if it is a person who has entered into an international transaction, gets 1 month to revise the return. And there is also a concept of filing a late return. That means that there also the time available is only up to December of the assessment year. Now, the department has been getting a lot of information, and as you might be aware, and some taxpayers also might be aware, that we are now sharing the information which we have collected from various sources, which is coming to the department, whether there is any deduction of tax at source on that income, or there is no deduction of tax, but we are getting as a specified financial transaction that is available with the department, that is being shared with the taxpayers, that is being shown to them, and they are being provided an opportunity to tell us that yes, this information pertains to me, then they can include it in their return. And if they say that no, it does not pertain to me, then we will be doing further verification. And if we find that it is a correct information, then we are giving them an opportunity. It is a nudge policy. We are giving them an opportunity to come forward and file their return. So for that, this updated return concept has been brought in. So if any taxpayer who has already filed a return can file an updated return. For filing an updated return, the time given is the time starts from after the end of the time which has been available under section 139(1) and 139(5) or 4, as I discussed, the timelines. After that, and 2 years from the end of the assessment year. So he is getting 2 months from the 2 years from the end of the assessment year to file an updated return. And who can file an updated return? The updated return, if you have already filed a return, then also you can file an updated return showing additional income which you had not disclosed in your earlier return. You can file it, because the sources from which we are showing the information to you, there might be some information which was not available with you, so you can utilize this opportunity and file your revised return. And those who can file, who are not eligible to file the revised return, that I will tell you first. This revised return should not result in reduction of income which was already filed. It should not result in refund, or it should not result in loss. So loss we have not covered here. And if a person against whom a search action has been taken, so the year in which the search has been initiated in 2 prior years, if the survey has been done, the year of survey in 2 prior years, if 132A requisition has been made that year and 2 prior years, that person cannot avail this benefit, because that is something, when we are doing these, taking these measures, search and survey, that means there has been a violation of the provisions of the law. So that benefit cannot be given to a person. A voluntary compliance cannot be equated with that. So that category will not be eligible for this. Then if search has been conducted in the case of A, and we get the information, the books, the documents which have been found out over there, they belong to B. So and that has, then that person also will not be eligible once it has been found out. So, and thereafter, if notice has been issued under Black Money Act, the assessing officer has information, and the notice has gone in Black Money Act, or under Benami Act a notice has been issued, so then that person will not be eligible. If I am getting information under the treaty, so the year for which I have got the information, it has been communicated to the taxpayer, that year will not be eligible. Or I have completed assessment under section 143.3 or 144, or some notice has been issued of 143.2 and all. So then that person will not be eligible, because action has already been initiated in that case, so that person will not be eligible. Now we have also provided that when you are filing your updated return, at that point of time you have to pay the additional tax. The tax which is due on that return, that has to be paid, and if it is not paid with the return, then that return can be treated as a non-est return under section 139(9) of the Income Tax Act, as is the provision for other types of returns for non-compliance with the other provisions like not filing the statement or not. So this is the eligibility, and now I come to the additional income tax which one has to pay. So additional income tax, if you are paying, if you are filing your return for the first time, if you have filed an updated return, you can file only once. You cannot update and update your return. That is not the concept. So when you are filing an updated return and it is being filed for the first time, that means you have not filed any return under section 139(1) or 4 or 5. So then in that case, whatever you are returning in your, whatever income you are showing in your return, on that, first your tax liability will be calculated, your interest under section 234 ABC will be calculated, and the fee, that will be calculated, and the tax and interest, whatever has been calculated, 25% of that you have to pay as additional tax if you are filing your return in the first year. That means 1 year from the end of the assessment year. Right. If you are going in the second year of the assessment year, then you have to pay 50% of that. Right. So that is the position for updated return which is being filed for the first time. If you have already filed a return and something was missed out by you, then in that case you can file an updated return. In that situation, since you have already filed a return, 234A will not be applicable, and we will be working 234B, and 234C will also be on this return income, because something, and then the while calculating the taxes in both the scenarios, in first scenario when you had filed it for the first time, the TDS, for calculating the advanced tax liability, the TDS, the foreign tax credit, the MAT credit, everything will be given to you with respect to the income which has been shown in the return, and then the liability will be calculated. So that what has already been done, just because you have not filed the return, but this tax was already deducted, so that will be taken care of. But if it is in the second category, when you have already filed the return, now when you are filing an updated return, it will be a incremental. So what you have already done, for that you will be given credit off, because that return, against that return you have already paid the TDS and taken credit of the taxes paid. Now incremental, whatever new income you are showing, with reference to that, if there is any TDS, if there is any foreign tax credit or any MAT credit, that will be given to you, and based on that your advance tax and all liability will be calculated for the purposes of levy of interest and for charge of interest and tax, and for calculation of additional income tax. So additional income tax, it has been clarified that while we are calculating the tax, it will include the tax surcharge and the additional surcharge. So this is the provision, and this updated return can also be a return going forward. There can be another assessment also is possible on if some other information is available with the department. In that case, the other provisions of the Act will apply. This is how it will work. Right. So the information which we have with the department, once it is shown to the taxpayer can just pay the tax and additional tax, and thereafter with interest and all, and right. Close. There will not be any further litigation if they follow the law the way it has been designed.
Yes. Ma'am, in the case of the IFSC in Gift City in Gujarat, this is one thing which has been a very ambitious project in order to create a global financial hub in the country. And over many finance acts, we've tried to incentivize transactions so that it is more conducive for financial business. So does Budget 2022 also take steps in that regard to make it more conducive for the growth and for the thriving of financial ecosystem?
Yes, some more tax concessions have been given to the for the development of the gift city, and 3-4 amendments have been carried out by the Finance Bill 2022. They are proposed by Finance Bill 2022. The last budget we had provided the transfer of non-deliverable forward contracts. Then any income is arising from that in the unit in IFSC of a non-resident, that will be exempt. So now they are also they are doing it now offshore derivative instruments that they are being trading in that, and over the counter derivatives. So transfer of these two instruments also, the income which is going to arise to a non-resident by doing it in the IFSC, that will be the proposal is to grant exemption to them. And last year there was the provision was brought that if there is a lease of an aircraft by a non-resident to a unit in IFSC, then any interest and royalty which is arising to the non-resident, then that will be enjoying exemption. So now they will also, this shipping is also being added to the aircraft. As you know that shipping and aircraft, these are the two things which go together so far as our treaties are also concerned. So the benefit of this interest and royalty to on account of lease of the ship from a unit to a non-resident will also be enjoying exemption. Now a non-resident, his portfolio can be managed by a portfolio manager who is sitting in the gift city, and the portfolio may be outside India. So the income will be accruing or rising to a non-resident outside India, but since the portfolio manager is in India and the account of the non-resident will be in India, so he will only be receiving the incomes because of his account being in IFSC. So this will be only because of receipt that will become liable to tax. So there is a proposal to grant the exemption because it is not accruing and arising in India. If it accrues and arises in India, then this benefit will not be available. Only if it does not accrue and arise in India, then the benefit will be available to it. And similarly, the section 56, which provides for taxation of any receipt which is below the fair market value or above the fair market value, whatever we say, it depends upon who the recipient is, in the hands of the recipient. So that but there is a concept that if the venture capital undertaking is getting any funding from AIF category 1 and 2, which is approved by the SEBI, then this provision does not apply to them, then this taxability will not arise in that person's case. So now the AIF category 1 and 2, they are also being approved by the IFSC authority. So this benefit is also proposed to be extended to them. So these are the benefits which are proposed to be given to them in the furtherance of the object which you have just now elaborated.
Thank you for that. Ma'am, and ease of doing business again, coming back to that, one important way in which the government has tried to ensure ease of doing business is by slowly phasing out exemptions one by one over the last many years. So can you please explain to us, are there any such exemptions that we have phased out in Budget 2022 and the rationale behind that?
Yes. See, this phasing out of exemptions and deductions, they are basically given for a short period of time for a purpose, for a limited goal, to achieve a particular goal. They cannot continue in eternity. So there are certain exemptions and deductions which are continuing on our statute book since 1962, since the statute came into force, and we have given certain deductions and exemptions I would say, to some category of non-residents where we are getting the taxing right under the treaty. Now, after moving forward and after the BEPS project and all, the tax treaties are also clearly stating that the treaty is not for double non-taxation. One country has to tax it. Now, if under the distribution of taxing rights, India is getting a right to tax, why should it give up its right to tax? And a concession cannot continue for eternity. It has to have a certain particular limit, particular period for which it should be enforced. So in that context, there are certain clauses of Section 10 of the Income Tax Act which are proposed to be made ineffective from assessment year 23-24. I'll just deal with them. What are those sections? What are those provisions which will not be effective from AY 23-24? Before that, I would say that from 2015, that was the announcement made by the Finance Minister that we will be removing the exemptions and deductions and we will be reducing the tax rates. So tax rates have been rationalized, they have been reduced to a large extent, both in the case of the individuals, also a second regime has been provided, and for the companies also, the rates have been slashed down substantially, and I think we are one of the, we are the most competitive rates we have as of now, if we compare ourselves with the rest of the world. So in that context, there are 4 clauses which are proposed to be made inapplicable from AY 23-24. One is if there is a technical cooperation agreement program, under that somebody is being given employment, there is an agreement between Government of India and a foreign state, and that person is being given employment here in India, that person, whatever remuneration he is receiving from the foreign country and the income which is accruing to or arising to him outside India, for which he has paid social security tax while he was a non-resident, that is exempt. Now, if the person is getting employment here and he is a direct employee of the government of the foreign state, treaty will take care of such situations. There is another situation where a consultant is appointed by under an agreement, and there is an agreement between the foreign government and the agency which will be doing this technical cooperation program. So that consultant also similar remuneration and this income accruing arising outside India on which he has paid social security tax, that is exempt here. Then an employee of a consultant, of this consultant, also is getting the similar kind of exemption. Now coming to the next is the family members of all these 3, they, whatever income is accruing or rising to them outside India on which social security payment has been made, that is exempt in their hands. So now for the person who has been employed under an agreement between Government of India and the foreign government and the family members, these 2 are existing in the statute since 1962 and the other 2 have been brought in 1991. So both of them have lived for a very long time in the statute, and the treaty is there to take care of these situations. Secondly, we also have a concept of resident but not ordinarily resident. So if somebody is here for a short time, then in that case and becomes a resident, so at least for a short period his only income which is accruing or rising in India only gets taxed. But residence, concept of residence has to be applied in accordance with the provisions of Section 6 of the Act, and accordingly the exemptions and deductions we have overlived or outlived their utility. They are proposed to be sunset.
Okay, thank you, ma'am. Ma'am, and the next question I would like to ask is in respect of the deductibility of taxes that are usually paid in the course of accounting for income under the head of income from business and profession. It was always clear that taxes that were paid cannot be claimed as a deduction when you're computing the income under that head. But in respect of cesses and surcharges, there was always a lot of litigation across the country. So in Budget 2022, as we understand that we have proposed an amendment in that ground to make sure that a lot of litigation gets cleared out. So can you explain a bit about that for our taxpayers?
Yeah. See, when we are computing income under the Income Tax Act, the tax which is on the profit which is being worked out, that cannot be allowed as a deduction, because if we allow that as a deduction, that means I am subsidizing the tax also which you have to pay. So that is the philosophy behind not allowing it. So business income is computed under the head profits and gains of business and profession, which is forming part of Chapter 4 of the Income Tax Act, and there it is clearly stated that income tax on this profits and gains is not allowed as a deduction. Now going forward, this tax, now how do we levy tax? Tax is levied as per Section 4. Section 4 says that income tax shall be levied by a central enactment. The Finance Bill or Finance Act, I should say, is the central enactment which provides for the rate of tax, and that central act only says that this rate of tax shall be increased by a surcharge. Section 2 of the Finance Act every year says that it shall be increased by a surcharge, and one of the subsections that is in some of the finance acts, it is subsection 11 or 12 and 12, they deal with these education cess which they are talking about which the litigation is, there is so much of litigation. There it is clearly says that this name, education cess, additional surcharge. It has been clearly defined that it is additional surcharge. So it is in the nature of surcharge, and surcharge is on the tax, and so therefore both have not to be allowed, cannot be allowed as a deduction under section 40 while computing the profits from this under the business head. Going forward, some of the high courts, I think 2 high courts have taken the position that this cess is allowable as a deduction, and they have referred to one of the circulars of CBDT of 1967, which does not talk about any this cess which is in the form of additional surcharge and levied by the central enactment. And there is a Supreme Court decision which says that the tax includes surcharge and additional surcharge. That has also not been taken into account by the honorable courts, and this has been very clear. The intention of the legislature has been very clear, and it has been very well defined under the Act and the central enactments. Therefore, this corrective measure has been taken to clarify, to reduce to put an end to the litigation which is being raised by the taxpayers by raising an additional ground of appeal in their appeals which have been filed by them. And so that is why it has been clarified, and this amendment has been brought from AY 2005-6, from when this education cess was was made applicable to the income tax.
Ma'am, so in the case of people who have already claimed this earlier as a deduction, what would they have to do now? How would they comply with this change now?
What the information which we have, they have not claimed in their return. In 1 or 2 cases, they have got it by way of appeal, and some of them are taking it as an additional ground. So now, after the clarificatory amendment has been brought, making it very clear that what has been the intention of the legislature, so I think courts will take cognizance of it and decide accordingly.
Thank you, ma'am.
Thank you.
So that was a brief yet insightful discussion with the member about how Budget 2022 helps advance ease of doing business and tax certainty. Do stay with us for the next episode on Budget 2022, during which we shall be talking about 2 more pillars of the budget proposals. Thank you and Jai Hind.